So we've been talking about it all week, declines, and we said that there was plenty of downside risk in stocks here for the short term, given some seasonal patterns, considering what's happening to interest rates, considering that we have earnings season around the corner, and so on and so forth. And so naturally, a lot of the questions that we received also from the public is what are the next potential downside targets. We did, of course, send out real-time trade alerts and discuss this with clients earlier this week. So now that we're seeing a bit of a move lower in broader stock markets, I wanted to also kind of, bring it out to the public how we can very conservatively and sort of in a 1, 2, 3 step process look at next potential downside targets. One of the things that you'll learn as a trader or investor over time is to never take victory laps, but rather take this one day at a time or 1 week at a time, depending on your time horizon. So let's quickly head over to the computer and let me show you guys how I measure this. So let's flip the camera. And so what the dashboard did, the Market Rover dashboard that we have, is it gave us a, in consumer discretionary stocks, like for example, Tiffany's gave us beautiful sell signal. See that sell signal that happened earlier this week? The stock has now already reached its first downside target. That's the kind of stuff that we learn to clients to in real time. Now we talk about the S&P 500 real quick, and you can see, let me make the chart a little bit larger. You can see what this looks like in very simple terms. So there's essentially 2 potential downside targets. We've already reached the first one, or at least touched it on October the 4th, on Thursday, which is that yellow line. That's your 50-day moving average. And I think there's room all the way down to about 280 or so. So that's sort of our next, or maybe the third potential downside target. Again, taking it 1 step at a time. So let me just draw this in from scratch with you guys in real time so you can kind of look at this through the lens of a repeatable process. So the highs here in January were around 286 on the SPY. This is the SPY ETF. And you can see we actually also almost got there yesterday. So this was a pretty big level between 286 and 287. Again, that also coincides with the 50-day moving average. If we break below there, then like I just said a minute ago, to me, really, I probably would then right away start looking at the next level lower, which is around 280, where we saw previous resistance, and it also lines up roughly with that blue line. This one here, this is the 100-day moving average. So that's honestly about what I wanted to show you. Also, again, one of the great things about the Market Rover is that it's been telling us all week, in fact, for about a week and a half now, that things are deteriorating. So for example, right now, if you look at the sectors, you can see that many more of them are short-term bearish or short-term neutral at best than short-term bullish. And we actually saw a lot of this happening in real time as consumer discretionary stocks, for example, where they actually went from short-term bullish to short-term bearish all this week. And that's one of the reasons why also we came across shares of Tiffany's, which of course is a consumer discretionary stock, and that stock has now tumbled quite a bit. Just to give you a bit of an idea of what this process looks like. So that's it. Have a great weekend. Talk to you guys soon.